Welcome to the Deep Dive. We're your regular source for, really getting under the hood of the latest earnings calls.
We try to pull out what actually matters.
Exactly. And today, we're digging into Skillsoft. They dropped their second quarter fiscal 2026 results just after the bell on September 9th.
Yep.
And there's quite a bit to unpack here. Numbers, management chat, the works. We want to get to the heart of what's going on with this learning tech company.
Yeah, this call definitely gave us plenty to chew on.
Yeah.
You had this massive beat on non-GAAP EPS on one hand.
Huge beat.
But then the market reaction was, well, pretty muted, even cautious, tells you investors were looking elsewhere.
For sure. So our mission today, cut through that noise, deliver the essential insights, and try to figure out Skillsoft's trajectory. Where are they actually heading?
Let's do it.
Okay, let's kick off with those headline numbers, because they really do paint an interesting, maybe a bit of a mixed picture. So Skillsoft reported non-GAAP EPS of 92 cents. Now get this, the consensus estimate was for a loss of $2.10. So yeah, a beat by over $3 a share. Pretty remarkable stuff on that front.
It really is. And even the GAAP net loss, minus 278 per share, that was an improvement from minus 484 last year. So progress there too.
But, and there's always a but, isn't there?
Usually is.
Revenue. It landed at $129 million. That was just a hair shy of the $129.2 million consensus.
Right. And maybe more importantly, it was down 3% year over year.
Yeah, that decline definitely catches the eye. However, their adjusted EBITDA held up pretty well, didn't it?
It did. Came in steady at $28 million. That maintained a healthy 22% margin, which, interestingly, is actually up a point from 21% last year.
So profitability looking kind of resilient even with the top line pressure.
Exactly. Points to some decent cost control, which we'll get into.
Okay, profitability solid. What about cash flow? Free cash flow for the quarter was negative $23 million.
Which sounds bad initially.
Right. But, and this is important context, year-to-date free cash flow is still positive $4 million, and Q2 is usually their weakest quarter for cash flow, just seasonally.
That seasonality point is key, yeah. You expect a dip in Q2.
So not totally out of left field. Still, the market's immediate reaction to this whole package, big EPS beat, slight revenue miss, negative quarterly FCF was, well, the stock took a tumble in after hours.
It did.
What do you make of that? Why the sell-off with such a strong EPS number?
Well, I think it shows pretty clearly that investors right now anyway are laser focused on that top line. The revenue miss, even if small, and probably more significantly the revised guidance we'll talk about,
Right.
that seemed to outweigh the bottom line beat. In this kind of market, especially for software, growth is often king, or at least perceived predictability is. A revenue stumble just gets more attention, initially at least.
Okay, that sets the stage nicely. So let's dive deeper into the business itself, because Skillsoft isn't just one thing, is it? They've got two main parts.
Exactly. You've got talent development solutions, TDS, think of that as their core digital learning platform stuff. And then there's global knowledge, or GK, which is more focused on live instructor-led training.
And the performance between those two is pretty different this quarter.
Oh, yeah. It's almost like two different companies under one roof right now. TDS revenue came in at $101 million, basically flat year over year.
Flat isn't amazing, but management was quick to point out something positive within that.
But they were. They highlighted this was the fourth consecutive quarter of revenue growth specifically for their TDS enterprise solution. That's a key proof point for them, showing that core digital offering is gaining traction with larger clients.
So the core digital stuff, holding its own, maybe even growing where it counts most.
Seems that way. It shows where their strategic focus is really landing.
Okay, now contrast that with global knowledge. GK revenue is down 10% year over year, landing at $28 million. That's a more significant drop.
It is. And that's the live training piece, remember? Management was pretty direct about it, that they pinned the blame squarely on economic uncertainty and weaker discretionary spending.
Is that the whole story? Or does it also signal maybe a bigger challenge for live training in a world that's leaning so heavily digital?
Look, it's probably a bit of both, wouldn't you say? Macro headwinds definitely hit discretionary budgets for things like live training first, public sector, smaller companies pull back.
Sure.
But yeah, it also highlights the structural challenge. GK isn't as natively digital. In a world shifting to remote, flexible, scalable learning, live training just faces a tougher climb. And their geographical mix doesn't always help, either 65% US, 26% EMEA, 9% rest of world. Different regions feel the pinch differently, and GK can be more exposed.
That makes a lot of sense. So with GK facing these headwinds, how did management respond in terms of outlook? They adjusted guidance,
They
right?
did. They revised their full-year fiscal 26 revenue guidance down. The new range is $510 to $530 million, down from $530 to $545 million previously.
And was that cut mostly because of GK?
Almost entirely, according to the Q&A. They were very clear the adjustment was driven by that softness in global knowledge, specifically calling out North America's public sector and also the Middle East. So a cautious outlook on that part of the business.
Okay, here's where it gets, I think, really interesting, maybe even a bit confusing at first glance.
Go on.
Despite cutting the revenue forecast because of GK, Skillsoft reiterated their full-year guidance for adjusted EBITDA, still expecting 112 to 118 million, and their free cash flow target of 13 to 18 million.
Right. Holding the line on profitability and cash flow.
How are they pulling that off? Lower revenue, but same profit targets. Are these sustainable cost cuts, or are they just, finding one-time savings from this transformation they talk about?
Yeah, that's the million-dollar question, isn't it? The CEO put it down to their ongoing transformation efforts. They're about a year into this big overhaul.
What does that actually involve?
Well, they mentioned implementing a dual business unit structure, separating TDS and GK more clearly. Improving operational execution, shifting resources around, building out the leadership team, and importantly, all this has led to about $45 million in expense reductions.
45 million is significant.
It is. And crucially, in the Q&A, they emphasized these were mainly fixed cost cuts, not variable costs tied directly to revenue drops. That suggests it's more of a strategic restructuring for longer-term efficiency, which can be sustainable, rather than just short-term belt-tightening. It's a deeper operational shift.
Okay, a strategic reshaping, not just trimming fat. That makes more sense. They also talked a lot about innovation, especially AI. Big announcements coming soon.
Yeah, they teased AI product news coming this month, September. Things like an AI authoring experience, more personalized skills development, scalable certifications using AI, better analytics.
And their own AI assistant, CAI.
Yep, they've advanced AZ, adding full voice mode, proficiency scoring. Plus, they've expanded their global learner support to over 50 languages now. It shows a serious commitment to embedding AI across the platform.
What did that actually mean for a customer, though? Is it just buzzwords, or does it change things?
No, I think these are tangible shifts. An AI authoring tool could drastically cut content creation time for companies. Personalized learning paths, scalable certs that speaks directly to the huge skills gap issue everyone's facing. Seizi with voice starts to feel like a real interactive tutor. It's about making learning more efficient, yes, but also more effective and, frankly, more engaging. Solving real problems.
And they're not just building stuff, they're changing how they sell it too, right? AWS Marketplace, Salesforce integration.
Absolutely. Smart moves. Listing on AWS Marketplace makes it easier and faster for companies already using AWS to buy Skillsoft. Integrating Seizi actions into Salesforce Agentforce puts their AI right where people are working customer service agents, for example.
Makes it stickier.
Exactly. More embedded, more accessible, maybe indispensable over time. And they back this up with some big customer wins: a global apparel brand, a semiconductor giant, a European digital services firm. Shows there's real demand for this kind of scalable learning.
And the usage numbers on their main platform, Percipio, seem to reflect that demand, especially around AI content.
Oh, definitely. The numbers were pretty eye-popping. Tech learners up 50% year over year. AI-specific learners up 74%. And get this, AI learning hours surged 158%.
Wow.
Yeah, customers are clearly leaning into the AI content. It shows that part of the strategy is resonating.
So even with the GK headwinds, the core digital platform and AI push seem to have real momentum.
That's the narrative they're pushing. Now, during the Q&A, management did admit the macro stuff has set them back maybe 3 to 6 months on their overall transformation timeline.
Okay, an honest admission.
But they also express confidence they can make up about a quarter of that lost time over the next year, year and a half. They see it more as a timing shift, not a fundamental, tectonic plate shift, as they put it. They're betting the AI and digital strength wins out long term.
Okay, so pulling this all together, what does this complex picture mean for you, our listener, trying to make sense of Skillsoft?
Okay.
You've got this clear transition happening, 2 stories. The steady, maybe growing digital TDS side.
And the cyclically challenged legacy live training GK side.
Right. And the market reaction, that initial sell-off, seems very focused on the GK weakness and the resulting revenue guide down.
Yeah, I think connecting it to the bigger picture, the market just hates lowered revenue guidance right now. Even with a strong EPS beat and reaffirmed profit targets, that top-line visibility issue often trumps everything else, especially when capital isn't cheap and growth is prized. Immediate revenue expansion often feels like a clearer signal of health to investors than margin resilience alone.
So it creates this real tension, doesn't it? Short-term revenue softness versus the long-term strategic pivot to AI and platform growth. It's that classic dilemma. Manage the present while investing heavily for the future.
Precisely.
So what should we be watching for? Key catalysts going forward.
Definitely keep an eye on those September AI product details. How innovative are they really? Secondly, any pickup in, say, U.S. federal budget spending could give GK a boost in the second half.
That live learning piece.
Yeah. And third, keep watching the TDS metrics net expansion, renewal rates. Are they keeping and growing those core digital customers? Skillsoft themselves basically said success is about durable TDS growth, margins, and cash conversion, not just raw revenue anymore, quality over quantity.
Okay. Given that whole dynamic, the market's reaction versus management's apparent confidence in the transformation, it does make you think about potential ways to look at this from an investment angle. And let me stress, this is absolutely not financial advice.
Definitely not. For informational purposes only.
But let's float a plausible, maybe slightly wild, trade idea for consideration.
Okay, let's hear it.
Well, given how the market hammered the stock on the revenue guide down, seemingly ignoring the reiterated profit and cash flow,
Yeah.
one could potentially consider a long position in Skillsoft. But maybe pair it, perhaps, with a short position in a more traditional, maybe less tech-forward, instructor-led training company. Or even a smaller short in a broad software ETF like IGV.
Interesting. So a pair trade. What's the thinking there?
The thesis would be that the market overreacted to the near-term GK problems, the legacy business headwinds. And at the same time, it's maybe underappreciating the underlying strength and momentum in the higher margin TDS digital business, plus that whole AI innovation pipeline.
So you're betting the market eventually catches up to the transformation story.
Essentially, yes. You're backing the long-term strategic shift. The pair trade tries to isolate that Skillsoft-specific transformation story from just broader market jitters or sector-wide pressures.
Right. So if Skillsoft does execute on the AI roadmap, keeps growing TDS, manages the GK decline effectively, the idea is the market might eventually re-rate the stock. It closes the gap between current sentiment and that longer-term potential as an AI-powered learning platform.
Exactly. It's a bet on the long game, the strategic execution, against the short-term market narrative. A classic transformation play, really.
A bet that requires patience, certainly.
No doubt. Okay, that brings us pretty much to the end of our deep dive into Skillsoft's Q2 fiscal 26 results. We've seen the company definitely in transition, showing solid profitability, good signs in its core digital business.
But also grappling with real macro headwinds hitting its more traditional offerings.
The path forward seems pretty clearly defined by their ability to execute on AI, keep that transformation going, and show durable growth from the platform side.
Absolutely. That's what investors will be watching.
So, as companies everywhere wrestle with skills gaps, AI integration, all of that, here's a final thought to chew on. How quickly will the market start to really differentiate between learning providers truly embedding intelligent, scalable solutions into how people work versus those still leaning heavily on older models?
And when that differentiation really kicks in, how might that fundamentally reshape the investment landscape in this space? Something to think about.
Indeed. Well, thank you for joining us on this deep dive.
And just a reminder, everything discussed here is purely for informational purposes. It is definitely not financial advice.
Please, always do your own research and due diligence. We look forward to diving into the next earnings call with you soon.